Hello guys, welcome to Saturday webinar. Let's begin. Okay, so this week nothing much going on. Okay, it's basically a very flat. Okay, not really flat week, but I mean we do have the Greenland issue over the weekend, and then after that, Trump immediately tackle within the week. So we have kind of like a drawdown, and then after that the market recover immediately lah. Okay, aside from that, not much is ongoing, but there are something that I want to show you also. Firstly, you can see we entered some Russell 2000 short position as hedging. So when we enter this short position, right, it was somewhere around here lah. Okay, it was entered as a hedging against whatever result that may come from the whole Greenland issue, but we didn't really expect Trump to tackle so fast and then the market immediately just recover. But then there were some of you who were saying, oh, we shouldn't even have hedged because the market immediately recover. And that is not correct in the sense that even with the current situation as it is, right? Trump going back on the tariff threat. This hedging is still pretty much very useful in your portfolio, okay? Because you can see on Friday, right? Even though the S&P 500 is like very flat, not really a lot going on Friday, but the Russell 2000 went down by 2%, and that is a very big divergence between the Russell 2000 and the S&P 500, okay? And you have to be a little bit careful when you see this kind of price movement also, because Russell 2000 is a small cap index, and usually the small cap index are in danger when there is any kind of macroeconomic situation going on. Okay, it doesn't have to be Trump related, it can even be um interest rate risk, because next week we have FOMC coming up. So that's one thing to take note. So it could be that the market is kind of deleveraging before Wednesday. Who know what may happen on Wednesday also. So it is good that we hold on to that short position. So don't go and exit that hedging, okay? And another thing that I realized also is I am doing a very private inner circle, like there's like 6 7 of us from our trading course. And one thing I noticed from this our group, and which kind of extend out to a lot of retail trader, is that there is a lot of misunderstanding, and there is a lot of knowledge gap in terms of lot sizing. Okay, I do realize that a lot of people are not very good at sizing your lot position when it comes to your stock entry, especially option and option entry. And when you are hedging, right? When you are hedging your portfolio using things like Russell 2000, right? The hedging lot sizing need to be very well thought out and very well calculated. Also, you cannot suka just go in one amount without really doing any kind of calculation. Okay, so I'm not going to go through how to calculate all those, because definitely it is not suited for this kind of Saturday webinar. But I just want to point out that make sure you are not over hedging, and make sure you are not under hedging also, based on what kind of exposure you have lah. So you have to understand, number one, how much are you exposed, how much of your portfolio is exposed, and number two, how much hedging do you need. So make sure you calculate all those, okay? Don't just anyhow enter. So another thing that I want to point out here is there is a very useful indicator on TradingView. Unfortunately, I cannot find this indicator on QuiFin, and currently, like all the software have this issue lah. Certain software have very niche stuff that only they have, and then I have no choice but to pay subscription for both in order to have access to some of the some of the stuff lah. Okay, but anyway, you can see here I have these two indicator here. So one is S5TH and the other one is S5FI. Okay, so what this indicator tells you is, okay, let's not use the candle, let's use the line chart, is how many S&P 500 stocks are above the 50-day moving average. Okay, meaning to say how many S&P 500 stocks are uptrend. Uptrend meaning their price are above the 50 days moving average. Okay, and you can see here is 62, 66.2. And what this means is that 66.2% of S&P 500 stocks are above the 50 days moving average. And the other one is, of course, the 200-day moving average. Okay, S5TH. 65.6% of the S&P 500 stocks are above the 200 days moving average, meaning to say more than half of the index is currently in an uptrend mode. Okay, but what I want you to kind of take note is when you see dispersion, divergence, when the S&P 500 itself is actually green or flat, but this market breadth indicator, this is called the market breadth indicator, okay, is coming down. Meaning to say, right, the market is being held up by all the big cap company like Microsoft, Amazon, Meta, especially on Friday, but the rest of the index is like falling very, very hard. Okay, and that's the reason why you see you are seeing things like the S&P 500 still managed to maintain, but Russell 2000 is going red, which can probably contribute to why the rest of the small cap, mid cap company are going down also lah. Okay, so when you see this kind of divergence, right, overall it is not really healthy for the market also, especially if this trend persists, right? If next week you continue to see S&P 500 green but the market breadth is going down, Russell 2000 is going down, then it means that there is risk in the market. Okay, so you can kind of use this as some kind of indicator also. Normally, if this is trending up, right, is usually a good thing. It means that majority of the market is participating in the rally. It is a broad-based rally. Macroeconomic conditions are very good. But when you start to see it coming down like very, very towards the bottom, right, where there's only like 17% of the S&P 500 stocks is above the 200-day moving average, right? Meaning, if you see it trending down, meaning we are going on a risk off mode, okay? So we are looking at the market as a whole, not just individual stocks or not just the SM, the max 7 stocks, okay? So this is what we call the market breadth indicator. So you can actually add both of this to your watch list also is something that you can monitor. So going on to next week, we have quite a lot of stuff coming. Next week is a very, very volatile week. We have a lot of major earnings coming up. Boeing, Texas Instrument, United Health, UPS, General Motors, ASML, GE Vernova, AT&T, Microsoft, Meta, Tesla, all three within one day. And then we have Federal Reserve, FOMC on Wednesday going into Thursday. Okay, so it will be 3 a.m., Thursday 3 a.m., meaning Wednesday midnight. Okay, and then on Thursday, we have the big one, Apple, Scandis, MasterCard, Caterpillar. And then on Friday, we have Sophie, American Express, Verizon, Chevron, ExxonMobil, all the oil and gas company. Okay, so next week is going to be a very, very volatile week given all the earnings and FOMC, right? And that is the reason why you should have some kind of a short position, okay? Because if you notice our current portfolio right now, everything is long position, okay? There's no short position at all, and you do not want to have that kind of portfolio going into a very, very volatile week. Okay, so with that said, right, let's go to the portfolio. I also want to cover a little bit on option restructuring, how to exit your option position that are highly likely unsalvageable, and you may want to reposition them into into a new structure where you can still profit meaningfully if the stock recovers. Okay, it is when the stock have fallen quite far from your strike price that even a 10-20% rally in your stock, right, it cannot hit the strike price really, meaning to say even if the stock recover meaningfully, right, your option is too far from the strike price to kind of make any profit. Okay, so let's just go through overall. We are starting off the year a little bit weak, but it is quite normal. There are some year where we only start to make profit during February and March lah. Okay, I do believe 2023 was the year. The entire first quarter was like under the water. We only recover sometime around like April, May like that, and as long as we are managing our risk, right, is nothing to be worried about. And this is where doing restructuring on your option position, option structure, and making sure that you are long short is very, very important, because if let's say market were to crash in the next week, next 1 2 week, you can see that I'm actually holding my total risk is $25,000, which is 27% of the portfolio, and you don't want 27% of your portfolio to disappear overnight. So active management is very, very important. Okay. Let's take a look at some of the position that I close out. I actually close out Starbucks before the very big rally. Okay, so I closed it out at $1.35. So there was an additional $3,000 loss that I've taken. So that will add to my overall realized P&L at about $7,000. And then currently the total unrealized right now is about $5,000. So that will come to maybe about $12,000 drawdown like that. But this is unrealized. Okay, haven't realized it, but we shall see how we can sort of restructure and recover from this. Let's take a look at some of the option risk. January is over lah. Okay, you can see January still here. That is fine, because the spreadsheet will only automatically update when the January ends. Okay, when the January ends on the calendar day, not the option expiration day. I don't know how to set the option expiration date um Google spreadsheet. Okay, I'm sure there are ways to go about it, but I think for now this is the best. In February, my risk is now reduced to $6,000, and that is mainly because I have gotten rid of Starbucks. Okay, I've eaten the loss, so my February risk is now very low. My March risk is quite high at $16,000, and my April is about $4,000. Okay, and you can see here for February, right? I only have 2 long call position, and I have 5 short calls, meaning there are 5 positions that is giving me credit, which is the reason why overall the risk is not that high lah, and usually that is what we want lah. Okay, we want to get credit in a particular month if our risk is very, very high. So let's take a look at some of the open position. Okay, so now the first one that I want to cover is actually Toast. Okay, so Toast, you can see here, right, there's a restructure threshold. If the restructure threshold light up, it means that you should probably assess the position that you have to see whether you need to restructure or not. It doesn't mean you automatically restructure, but it just means that you go and take a look at it. You go and work out the math a bit, see whether restructuring makes sense or not. And that is when your option lose 60% of the value. Okay, if your option lose 16% of the value, then maybe it's time to go and reassess a bit. So in this case for Toast, right, let's take a look at Toast. Currently it is like not doing that great. On Thursday kind of recover a bit, but on Friday down about 1.2%, so it kind of like flatlining there. Okay, but if you want to talk about technical, you probably have like a potential double bottom only if it goes up. Okay, if it doesn't go up and go down, right, then you still have the downtrend that is ongoing. So since Toast have hit the restructuring threshold, right? One thing to ask yourself is whether or not are you still convicted in this trade? Are you still confident in the trade, and whether or not it can go right in your direction? Mainly because right now we don't really have any catalyst at this moment. The catalyst will come in on 12th of February, which is the earnings. Okay, so if this stock were to go up, right, aside from macroeconomic condition, for example, next week we have FOMC. So if maybe FOMC is very dovish and is kind of bullish for the market, right, then perhaps this may recover from a macroeconomic catalyst lah. Okay, but aside from that, we probably have to wait until 12th of February for this to do a meaningful recovery. Okay, so now originally when we enter, right, the price was somewhere around here, I believe, and we were actually looking at $45 as our target price. So at that point in time, that from that our entry price, which is the entry price of the stock, okay, not your option, from the entry price to the target price, right, is about 21% up. That is very doable, especially back then when we entered. When did we enter this? We actually entered this in December, okay. So when we entered this in December, right, and looking at until February expiration, right, we have about 2 months, okay. In fact, 3 months. We have the entire of December, we have January, and we also have the first 3 weeks of February. So we have about 2.5 months for this stock to go up 21%, and that is very, very doable if the stock kind of recover from there, okay. But unfortunately it kind of like stagnant, it kind of like stuck there. And from the current price, which is at 33.8 all the way to 45, right, we are actually looking at 33%. The stock actually need to rally another 10% more, and maybe it might not be doable, especially when we only have 1 month left. The stock is gonna expire in February, so we only have another month left. And within that 1 month, right, to do a 33% rally may not be that plausible, okay. And during the earning, it has to rally significantly during the earning, and maybe it also need another other catalyst from, let's say, maybe the FOMC lah, the inflation number, the inflation number, the unemployment number in February, all those kind of stuff lah. Okay, but that is to say, if we were to keep the option as it is right now, right, it is somewhat dangerous lah. Okay, we are running out of time, and if the stock kind of stays stagnant, we are in the final month of the expiration. That is when your time decay will accelerate. The stock doesn't have to move, your option will decay quite quite a lot every day, simply because we are in the final 30 days of the expiration. Okay, so what you want to do is you probably want to restructure this to something else, but we cannot just anyhow go and enter another option without truly understanding the numbers also. Okay, so we need to work out the numbers. So firstly, right, I have taken $1,000 credit from the short leg. What I am left with is the $6,000 risk on the long leg. So the total risk here is 5,000 now, okay? But you can also see here the option already lost about $2,500 in value. So if I deduct this from $6,000, right, I probably have about $4,000 left, okay? Meaning to say, if I exit this position on Monday, right, I can salvage $4,000, which is quite significant. So you do not want to let that $4,000 go to waste. If you still want to be invested in toast, you probably want to do something about it. Okay, so there are two choices here. There's a decision making point here. Number one, am I still convicted in toast? Do I still think that this can go up? If the answer is yes, then I may want to restructure the trade so that it has a higher probability, because this is going to expire in February. I cannot let this trade sit for the next 20, 30 days and then just leave it to luck. That is not a good way to handle the trade. If you think that, okay, maybe this trade cannot, I give up already, then it's very simple. You simply just exit the trade. You actually save $4,000, which is quite a lot of money. Okay, so now in my case, I am still highly convicted in this trade. I think during earnings it can recover, but I will probably give it more time for it to recover even more. So when I restructure, right, I may probably want to push the expiration out to March or even April. Okay, so we have to calculate and see what is going on. So let's take a look. This is the current position. Okay, this is the current position. Toast. My contract is $3.17 per contract. I have 20 contract, which give me $6,340. and currently it is already losing $2,460. Okay, my current price right now is 1.94. So let's say, okay, let's say toast recover lah. Okay, let's say toast recover to let's say $40 during the earning. $40 is about 18% up, which is all right. So if toast recover back to $14, right, I can get about $3,000, $3,600 in profit at expiration. But if it recover earlier, let's see when is the earning. The earning is like on the 12th. So let's say it recovers sometime during earning, okay. What stock is it? Let's say it's recover sometime during earning, then I may probably get like very close to 4,000. Okay, I can get $4,000 profit, which is good, which is all right. But the thing is, I only have until February, and if it doesn't move beyond that, right? If it kind of like stuck there, right? Then I'm not going to make a lot of profit, okay? Or if it continue to go down, right? I will lose the entire contract. So when we restructure this, right? We want to sort of trial and error a bit. So basically, what I have is, I try to push it out. I try to push the expiration out to March, and I remain the strike to be at $35. Okay, the strike is still at $35, and then I will write another February call option. So in this case, this is a ratio calendar. Okay, I have 14 contract in March, and I have 7 contract in February, which I am writing. So now in this situation, if it goes to $40, right, what's gonna happen is that my profit will be somewhere around 4,005, about $5,000 like that. So now what you need to understand also is that when I am restructuring, right, what I'm trying to do is I will exit this position, I will take the loss, I will eat the $2,460 loss, and with the remaining $4,000, right, I will restructure it. Okay, so meaning this new trade that I put up, the risk cannot be $6,000. The risk will be somewhere around $4,000. Okay, so this one, sorry, this one. So currently you see here my structure is about $3,000. So maybe I push it up to $4,000. Okay, so we are comparing apple to apple. So maybe I do 16 and 8. Do I get 4,000? No, maybe I need to do 20 and 10. I think 20 and 10 I will get a little bit higher than 4,000. Okay, let's be conservative a bit. Let's go lower. So you have to play around. Okay, 3,800. Okay, so I think this is good. 18 contract and 9 contract. So if I have this structure and it go to $40, right? You can see I'm getting about $6,000. Okay, I'm getting about $6,000. And I also need to consider that I have taken the $2,400 loss. I've taken the $2,400 loss here. So my net profit, if the stock rally to $40, is somewhere around $3,000 plus okay, about $3,000 plus, and that is very similar to this one. I have about $3,000 plus, very close to 4,000. So that's plus minus about $500 like that. Okay, but if the stock rallies to $40, right, both the restructured position and the original position, right, they will return the same amount of profit. And if that is the case, right, then my question is that why not restructure? Because by restructuring, you've given yourself more time. You have extended the expiration out to March. Whereas in February, right, you are sitting there eating the time decay. And if the stock is stuck somewhere around $39 or $38 by expiration, right, you don't have time really, okay? Your option will expire. So in this case, right, if the profit is actually very similar at $40, then I would prefer that you do the restructuring because you get to extend your expiration all the way out to March. So another question, another question is, what if the stock rally to $45? Okay, then you may be thinking, yeah, the stock rally to $45, I might as well stick to my original position. So we need to work that out to see, okay, if it does rally to $45, right? How does the new position turn out for us? Firstly, you also need to consider something, and that is how probable is toast to rally to $45 within February, within the next 30 days like that. That is like 33% rally. Okay, it may not be probable, but for the restructure position, you have until March. So you have one additional month, and that one additional month may be what you need for the stock to go to 45. Okay, so my point here is it may be able to go to 45, but it may not be able to do so within the February expiration. But let's just compare anyway. So if it goes to $45, the original position will return about 13K, okay, 13.7K. And our restructure position will return about 10K like that, okay, about 10K. But what you also need to take note is that this is actually a ratio calendar. A ratio calendar meaning your short leg is actually losing money, okay. You can see if I have just a long leg, right? My long leg is around $18,000, which is a lot, but the short leg is losing like $4,500. So that is if the stock actually rallies before the February expiration, okay, before the February expiration, which is on the 20th Feb. So what if, okay, what if the stock stay below $40 by February? I can collect this $500 credit, and only after February expiration, then the stock rally to $45, maybe during middle of March or beginning of March, then it hit $45. How much am I going to get? So let's see it here, meaning I will just have the simple call, okay? Who is messaging me here? Okay, so in this case, right, I have 18 contract, and if it rallies all the way to $45, right, I am going to get about 13K. Okay, I'm going to get about 13K, which is very similar to what we have with the original position, which is a 13K here. But on top of that, right, I am also going to get the $500 credit here, which will give me about 14K, okay, which will give me about 14K. But you also need to account for the fact that after the February expire, right, I can actually add another short leg in March, turning it into a vertical. If the stock actually rally to $40, right, then probably the March contract for strike 45 is very, very high, and I can short strike 45 at a very high price, and that can push my risk reward higher. Okay, so you can actually see here by restructuring, I don't really have anything to lose. I'm keeping my risk the same. It's not like I am putting up a fresh $6,000 risk. I'm just risking whatever I have left in my original risk, okay. And then I am trying to push, improve my risk reward ratio, improve my duration. And in this case, right, you can actually see by restructuring, there's only positive, there's no negative. But by leaving your trade as it is, you can actually lose money even though the trade goes in your direction, simply because you may not have the time, and perhaps the stock can actually able to hit $45, $50, but it will probably hit it in March. And if you are holding the February contract by itself like that, right, then you are not there to take advantage of it. Okay. So in this case here, I will probably restructure to this March 35, February 40 in on Monday, okay. It will give you a much better risk reward ratio, much better optionality, and better control over your position. And if let's say during earnings, right, it doesn't do well, you can actually still exit this and probably salvage around $2,000 or maybe even $1,500, because there is still significant time value left. If the stock don't crash like 10-20%, right, you can still probably salvage $1,000 or $2,000. But if you stick to the original position and the during earning it doesn't do well, most likely your option is a gone case. Okay, there's no recovery already. You will probably lose the full full $6,000 risk lah. So what we are trying to do here is that we are trying to minimize loss as much as possible. So if you consider the scenario where we enter toes in our original position and then the stock went up immediately, then we are going to join instant profit benefit out of it. And if that's the case, right, we actually go in with a $5,000 risk and we are able to enjoy the profit that is coming from the $5,000 risk. But if the stock didn't go in our desired direction, it goes against us, and when we restructure, we try to do some active management, we can actually cut down our loss to probably $2,000 or $3,000. We don't need to lose the entire $5,000. So on winning trades that you win, right, you are winning the full amount based on a $5,000 risk. And when you are losing, you are able to minimize risk to $2,000, $3,000. And that is the kind of risk reward ratio that you want. Okay. So when you are playing option, it's very important to always be actively managing, not just buy and then leave it there and then pray for the best. Because if you do that, right, highly likely that you're going to be eating a lot of full losses. But when you are taking profit, you are not really getting a lot of profit. You're probably running away with very, very small profit. And if, let's say, toes goes in our direction, okay, best case scenario, we get this credit, and then by March, toes go all the way to $45,000. What are we going to get? We are going to get about $14,000 profit, and that $14,000 profit, right, will be able to push our portfolio to the green. And that is only one trade. We only need one such trade to go everything in our direction according to plan. Then we'll be able to push our portfolio by a significant amount. Okay, so in this case, right, 14K is actually 14% of the portfolio capital, and we have a lot of trade. If within a year, right, we are making like maybe 80 trades, right, we only need like 10 of such trades to go in our favor and get the big profit, and the rest of the trade, right, as long as you are minimizing your loss, your portfolio should be able to do very well. Okay, so this is one example that I'm showing for toes. So I will show another one again, and in this case is for Symbotic. Okay, the reason why I'm looking at Symbotic is very simple. If I go to my open position, my Symbotic also have reached the threshold, okay, the restructuring threshold. For Symbotic, I entered quite a small amount, about $3,000, okay, and it lost about 1,400 already, which is basically 50% of the value, okay. So I only have $1,400 left, and this is also expiring in February. Okay, so we always come to the same conclusion, the same kind of assessment, okay. So originally the stock is strike 75, strike 90. So 75, wait, let me remove the strike 75 is here, and our strike 90 is here. So this is the short leg, okay. So our target is strike 90. So from current price until 90, right, is about 45% rally. Symbotic have good enough volatility to do that, okay. In fact, we can leave it as it is, but I just want to show you an example also. And your strike price is about 20% away, meaning the stock need to move like 20% just for you to break even, okay, because we did play a OTM option, and when we play, the price was somewhere around $68 like that, okay. But since our entry, it has dropped quite a bit, it has dropped about 10% like that. So probably we need to restructure a bit, okay. So in this restructuring, right, let's take a look at the original position. This is the original position I have. I'm risking, wait, is that the original position? Okay, this is the original position that I have. I'm risking $2,844 in a vertical structure. If it goes to $90, I can get about 10K, and this is February expiration now, okay? So if we restructure, what's gonna happen is that we're gonna take this loss, we're gonna take the $1,400 loss, and we will still have $1,400 left from our original risk, okay? So in the new restructured position, we are only going to enter $1,400 worth of position. So in my restructure, right, I'm still gonna keep the expiration to February. I'm not gonna like extend it out because I believe that if it does not go up during the earning, right, probably it's not gonna hit the target, okay? But what I did was I actually lowered down the strike price. I lowered down the strike price to 65. I lowered down the strike price, the short leg to 80. Originally, it was 75 and 90, but in this case, I lowered it down to 65 and 80. And what this means is that if the stock rally to $75, I am going to get $2,500. Okay. And then considering that I have eaten $1,400 loss, my net profit is $1,000. So now even though the $1,000 profit is doesn't seem like a lot, it's only 1% of the portfolio. But if you compare to the original structure, in the original structure, if the stock only goes back to 75, I'm actually losing a full amount. I'm actually losing the entire $2,800, mainly because the $75 is my original long strike price. Okay, if it cannot go beyond $75, I'm not gonna get any profit. But in the second structure, if it goes to 75, I am still getting something. Okay, I'm still up $1,000 on top of the fact that I managed to salvage the position. Okay. So because the strike price is at 80, right? 80, the short leg is at 80, my profit is now capped at 80. So at $80, my profit is $4,500. Okay, my profit is $4,500, and then considering that I'm gonna eat the $1,400 loss. In this case, my profit is $3,000. Okay, $3,000 profit. So let's take a look at the original position. The original position, if the stock only goes to 80, my profit is only $1,600. So this revised structure, I can get twice the amount of profit at $80 compared to the original structure where I am only getting 1,006, but in this revised I'm getting 4,005. But we deduct the loss that we are gonna eat in order to restructure lah. Okay. So now if you are gonna restructure to this, right, the idea is that okay, the stock dropped quite a bit, it cannot hit $80, it probably cannot hit $90 already, probably can't even hit 85, maybe 80 lah. Okay, 80 seems like a little bit more realistic. And if let's say the stock kind of like rarely but not so much, it kind of stuck at 75, you are still getting something. But for the original structure, the stock have to minimally go above 75, and even at 80, right, you are looking at a performance that is not beating the restructured position. Okay, the restructured position is still better at $80. And that is to say, if you are looking to keep to the original structure, the stock minimally need to go beyond 85, meaning it must hit $90. If it cannot hit $90, right, the restructuring position is superior in every way, okay, while we are maintaining the same risk. So do I want this? Probably yes. Why not? Or you can be greedy. I mean, during earnings, right? Symbiotic definitely can rally like crazy lah. Okay, so you can see here, this one during in a span of 2-3 days during the earning, it went up all the way. It went up by 64%. Okay, but this is something that you can consider lah. So in this case, it's more of whether you are greedy or what lah. Okay, definitely in the restructuring, right? If I set this to 90, I don't think it can meet. Let's see. Let's see. I set this to 90. we have to play slightly smaller amount because the credit we get is smaller. Okay, 1,004, just nice, very close to 1,004. Okay, so if it goes to 90, we can get about $6,000. Okay, $6,000. In this case, we are getting about 10K lah. Okay, so if it goes to 90, then the original position is better since we have the same risk, since we are dealing with the same expiration. The original position is better lah. Okay, but the question here is, of course, can it go to 90? If it's stuck somewhere along the way, do you have some kind of recourse? So the original position, if you choose to keep this, is very greedy lah. Okay, it's very greedy. But I mean, if you are greedy, then that's fine. But the restructure position is a bit more conservative. You can still get out at break even or a small profit, even if the stock end up somewhere around $75-$80. Okay, so this is the restructuring. Okay, so VITL on Thursday went up like 10%, and then on Friday came back down like 5.75. So for those who did not attend yesterday, right, VITL is actually, this is something that I just learned yesterday also. It has 28% of the floating share shorted. That is very close to 1/3 lah, okay, or very close to 1/4. About more than a quarter of the floating share is being shorted, and the short interest ratio is actually 7.1 days. So I was kind of a little bit confused as to why the stock is diving so much, but of course, firstly, it is egg prices are not doing that great. Aside from that, I can't think of any other reason why lah. Okay, because Vital Farm fundamental is very very strong, and after I kind of dig around a bit and I came upon this and I realized that actually there's a lot of shortage within this stock lah. Okay, and that is also to say, right, if during the earnings, if we can get any kind of positive catalyst, there could be a potential short squeeze, and the short squeeze may actually send this to 45 or 50 lah. Okay, so for short squeeze, right, 50%, 60% is something that's very doable. But in order for that to happen, we probably need some kind of catalyst lah. Okay, and I'm hoping that this earning will be the catalyst that we need. So even though for Vital Farm, you can see there is it is also meeting the threshold already, the restructuring threshold. I'm not going to restructure it because we actually restructure it one time already. So this is the second restructure. And if I mean I can restructure the third time, but I probably won't have a lot of value left. I only have like $900 left, and I don't think that's gonna make sense lah. Okay, so in this case, I'm gonna leave Vital Farm as it is, but you can see I have entered another very small position of Vital Farm at strike 40 for $600. So this is a very very tiny position. It's something that we entered actually we entered yesterday. We actually entered this yesterday. Potential short squeeze lah. Okay, so this is in case a short squeeze happen, and if a short squeeze happen, how much can we get from it? So let's take a look. How much is our price? 75 cents. Okay, 75 cents. So this is in April expiration. Strike 40, we got it at 75 cents. 75. Okay, how many contract do we have? 8 contract. We have 8 contract. Okay, we have 8 contract. So our strike is at $40 lah. Okay, and if it goes to $50, example lah. Okay, example, if a short squeeze happen and then it goes to $50 or $52, the recent high lah. I'm gonna put to 55. You can see your $600 can actually become like 10K, 14K like that, 11K like that. Okay, that is if the short squeeze happen. But in order for the short squeeze to happen, something positive must come out during the earning lah. Okay, and it requires the stock to move like 93%, which is a little bit far-fetched under normal condition, but in the presence of a short squeeze, definitely doable lah. Okay, and If you have a very big account, like you have a 100K account or even 50K account, risking $600 is actually fine. Even if you can't risk $600, right? Maybe you buy like, I don't know, you buy like two contract, it's only $150. So you buy two contract, $150. If it goes to 55, you actually get like, I don't know, $2,800 out of it. Okay. Which is still good for a $150 risk. Is better than Toto or what no lah. I mean Toto is better lah, but still is that there's a potential probability behind it lah. Okay, so these are some of the position that I just want to go through lah. Okay, so we also actually entered Enphase. Enphase is another potential short squeeze. So let's take a look at Enphase. Enphase is a solar panel designer manufacturer lah. Okay, they install solar power energy for residential, and recently you can see that the stock actually down for quite a bit, 91%, and recently it's kind of showing a little bit of life, a little bit sign of life, and it is also a very high probable candidate for short squeeze. The short interest is very high. The day to cover is also very high. Let's take a look. Enphase. Okay, you can see 25% share shorted, about 7 days to cover. Okay, very similar to VITL, very similar to Vital Farm. But recently Elon Musk say something about SpaceX is gonna consider using solar panel to set up in residential home or set up in rocket to power don't know what AI stuff. Doesn't matter lah. Okay, doesn't matter the feasibility or whether it can be done or not, but it does generate some kind of buzz and some kind of like a catalyst for the stock to move lah. Okay, in fact recently quite a number of solar related stock move. Sorry, I can't find my arrow. What's my arrow here? Okay, recently a lot of solar power related stock move quite a bit. First Solar went up quite a bit here. The other one is Sunrun. Sunrun also went up quite a bit. Sunrun also went up quite a bit. So a lot of the solar power companies recently price kind of recover a bit. Okay. So anyway, we are not really playing like a proper trade like that. Once again, you can see here I only put down $900. But you can see the strike price is at $80 lah. Okay, the strike price is at $80. So this is once again another short squeeze lah. Okay, another short squeeze lottery play. If it happens, it happens. If it doesn't happen, then I lose that $900 lah. Okay, that's the reason why Enphase is there. So toes go through ready. Dutch bro kind of like recently retraced a bit, but I think that's fine. That's fine. In fact, the Dutch bro mentioned something about the overall their cost is a bit high due to coffee prices, but recently I see coffee prices came down quite a bit also lah. Okay, but from technical perspective, it's not doing much. It's kind of like stuck there lah. Okay, it's kind of like stuck there. So as I mentioned yesterday, this one it can either violently go down or it can go up very violently lah. Okay, it's not gonna stuck there forever. It's kind of like consolidating a bit, but hopefully it is the upward direction now. Okay, so you can see here, right? For Dutch Bro, I have taken also $1,000 in credit when I entered this originally, and you can see here the long leg is $605,000. But I've also entered another short leg, which is capped in a form of ratio. So you can see I have twice the amount of long as short, so that if the stock rally, right, I can still profit. And the new short call is at 65 strike, and I'm getting another $1,300 in credit okay, so as long as the stock stays below 65, by February expiration, right, I'm gonna get that credit. But if it rarely, it's fine for me also, since it is in a form of ratio. But what I basically did is I basically reduced the risk of this trade further by another 1,003 lah. Okay, so originally the trade was about $5,000 risk, and then I reduced it by another $1,000, so now it's sitting at around $4,000 risk lah. Okay, and if it does continue to consolidate, right, I'm very happy also. So if it stays this way, right, I won't be like angry about it lah. Okay, I'm perfectly fine with that. I don't need to rally. I don't need it to rally immediately. Going sideways until February expiration is the best case scenario, and the earning is actually after the option expiration, which is good because you don't want the stock to move too much before the earning. Okay, so if the stock actually kind of remain somewhere around here, or maybe go up a bit, then by expiration, right, we can actually add another short leg in March, and we can turn this into a vertical. And when we finally turn this into a vertical, right, we can actually short another 1,000 10 contract, 10 contract short leg lah. Okay, and that will significantly reduce the risk even further. Maybe I can get it to the point where my risk is only like $1,000 from all the credit that I'm receiving lah. Okay, so far Dutch Bro is going exactly the way it wants, and if it rarely and it goes very well in our direction, right, maybe this one Dutch Bro trade alone, it can give us like 10k 20k profit from that one trade. Okay, so we are pumping out a lot of trades, but what we want is within all these trades, right, I only need one of them to do well. The all the other, I will manage them. I will try to keep the risk low, and hopefully over the course of the year I have 5 or 6 trades that goes really well, and that can account for like about majority of your profit already lah. Okay, Shark Ninja still says staying there. I will continue to hold on to it. There's not a lot of risk there, only $1,500 risk. And Entergis, ENTG, recently came down a bit, but this position is still very strong. Okay, so for Entergis, right, the short leg is actually at 120. So the reason why I put the short leg very nearby is because I thought that this one over rally a bit. It may come down, it may dilly-dally, and it seems like it's doing that lah. Okay, so no reason to panic unless it suddenly dive down. Then if it dives down, we will probably look to restructure again. Okay, but ENTG expiration is all the way in April, so that's fine. Not in a hurry. Okay, sorry, not April, March. Is it March? So we are not in a hurry. So we are doing quite okay. Symbiotic cover ready, Vital Farm cover ready, Marvel Tech. So recently I have put up Marvel Tech also. And in this case, you can see here my entry not very big. Okay, I only enter about $1,000 risk. And the reason is very simple. I don't want too many position in the semicon tech AI area lah. Okay, because we got Symbiotic, we got Marvel, we got ENTG. So I don't want very overcrowded trade lah. Okay, so I will enter maybe $1,000 first, and if it start going in our direction, then I'll probably add more position. Okay, but if it just go all the way down, then never mind. I just eat the loss. So I think it's fine. And finally, we have the IWM. So you can see here my IWM is about $2,400. The risk reward ratio on this is about 5 times. So if this goes in my direction, right, then the profit that I'm gonna get is about 12k 13k like that lah. Okay, from this position alone, and that is expiring in March. So meaning to say, you can see March my risk is about $16,000, and if that one position can cover this $16,000, right, then that's good. That's fine. That's fine. And I'm not really risking a lot. Also, I'm only risking like $2,400. Okay, so this is my hedging position. It will cover me all the way until March. You can see that I don't have Tesla. Basically, you don't need Tesla if you feel that IWM is good enough for you. But if you want Tesla, I think that's fine also. Okay, so now let's take a look at some of the potential trades in the future. Number one, tech short. We need some tech short to sort of cover up all the tech position that we have. Okay, so I'm actually looking at Dell and HPQ, but I feel HPQ kind of like all the way down already. So maybe Dell is a potential candidate, okay? But I'm still looking into it a little bit more. I'm kind of looking at Broadcom also, but Broadcom has a lot more moat compared to Dell. Dell kind of doing things that everybody else can do lah. So maybe this is something that I'm looking at, and from a technical perspective, you have the very classic head and shoulder lah, okay? And the other one that I'm looking at is actually this ETF called IGV. IGV is the software ETF. So previously we have talked about the software sector. The SaaS sector is gonna do very bad because the AI is coming to take their job. And previously we have a Salesforce short. It didn't earn money, but we managed to salvage some of the loss here. Okay, but I do think the risk is still there. I mean, we enter it at the not an ideal level. Okay, in fact, this one, if we kind of restructure this, it will probably go well in our direction, but we didn't really restructure this. But anyway, the overall software sector is kind of like in somewhat in danger lah. Okay, you can even see Microsoft doing very bad. Even though yesterday it kind of recovered a bit, right? You can see Microsoft is severely underperforming the rest of the Mac 7 lah. Okay, so Microsoft is not doing that great also because right now OpenAI is basically becoming a liability rather than the goose that lay the golden egg. So this ETF can be a broad market short lah, okay? So let's take a look at this ETF a bit. What is inside this ETF is all your usual software stuff lah, okay? Microsoft have the highest weightage, which is the reason why you are seeing this ETF kind of recover on Friday, even though the rest of the stuff are not really doing that great. Salesforce is red. Then the second biggest holding is Palantir. Palantir also recover about 2.23%. Then you have Oracle, Salesforce, Intuit, Applovin, Adobe, Palo Alto, CrowdStrike, ServiceNow, Synopsys, all the usual name there. Okay, so you can see it by the weightage and by how much they are performing within one day. Okay, wow, this LIF went up by 24%. Yeah, I think it's earning. Is it earning? But the weightage is very small. Okay, but yeah, so it could be a very nice hedging position that we can take against our overall portfolio also. Okay, so you can see right now my total position, right? I have 8 long call and 1 long put. And then the shorts, I don't care. Okay, the shorts are basically just getting the credit. But I have actually a total of 9 position with 8 bullish position and 1 bearish position. So if I can put up maybe another 2 more short position, 2 more short hedging position, making it 8 long 3 short, or maybe 8 long 4 short, I think that will round up the portfolio very nicely. Okay, and then from then onwards, I don't have to look for new trades as often. I just need to manage my portfolio to see which one going well, which one not going well. Okay, so once I remove my toast from February, right? You can see toast is like contributing about $6,000 in risk in February. Once I remove my toast from February, right? You can see that my February will actually become positive because of all the credit that I'm getting in February. And then I'll probably push that risk into March. And then now my March will probably be like $20,000 because I'm going to put about 3,000 additional 3,000 risk into March. It will probably be March risk will be about $20,000. And then we shall see whether if some of the March position goes into profit because Dutch Bro is in March. So if Dutch Bro goes into profit, then we can probably get rid of some of the risk. We have Shark Ninja in March also. We have Entergis in March also. And we have IWM in March also. So March is pretty much all right, okay. Even though the position is very big, the risk is very big in March, right? We actually have IWM covering a significant amount of risk, but at the same time, Dutch Bro is looking to do well. Shark Ninja currently doing quite okay right now. I can even actually for Shark Ninja, right? I can even add a short call here if I want to. The short calls are very very good in terms of the premium, okay. It's something maybe I will go through next week lah. Not really in a hurry. But if I can add a short call into Shark Ninja, right, I can definitely reduce the March risk, and then once Dutch Bro February contract expire, I can reduce the March risk even more. And if some of the March contract gets profit, the risk will go down. If some of the March contracts are not doing well, maybe we restructure it, get further roll out into April. So we are handling month by month, okay, to ensure that we are not blowing our account up. We are kind of managing our risk, and we are trying to take credit, take profit along the way lah. So far this year, we have not really taken any kind of big profit yet. Basically, a lot of the position are losses lah. Okay, some of them are carry over from last year. I think the only profit position, actually there's no profit position at all. In fact, one of the profitable position, which was SITM, we actually get rid of it in December lah. Okay, we didn't carry it over. In fact, all the stuff that we carry over are all the losing trade lah. So we actually took loss on Beautiful Source, we took loss on Vital Farm, we tried to break even on Shark Ninja. I mean, I could have taken a profit, but I want to keep my position lah. Okay, I break even on Shark Ninja. I get credit from Toast. I took a loss on Starbucks. So there is in fact losses from two positions, okay? Three positions. Vital Farm, Beautiful Source, and Starbucks, and the rest are credits that is coming in. But even with three position loss, right? And if you consider that when I go into this position, I'm actually taking $5,000 risk per position. But I have only realized about $7,000, which kind of like reduce the amount of loss that I should be getting by half lah. Okay, if I just leave the position as it is, right, I'm probably gonna lose $15,000 even before the first quarter end. But I'm kind of managing my risk with all the credit collection and among other stuff lah. Okay, but of course, if once things start to finally get profitable, right, because I'm entering $5,000 risk, the profit will be very very big. Also, every profitable trade will be contributing like 10K, 12K, 13K kind of profit. And you only need 10 to 12 such trade in order to get 100% return on your portfolio. The rest of the stuff, just make sure that you are not taking up too much risk. You are actively managing to keep the risk low lah. Okay, guys. So basically that's all I have for today. It take a bit long, mainly because I want to show you the thought process and the calculation that goes behind the restructuring. Okay, it is very important, and this is something that very hard to show in theory, because in theory you will never come across this kind of real life situation. Okay, so have a great weekend, guys, and I will see you all next week. Bye bye.